Each daily chart has a previous day high and low. The previous day's high and low levels are very important levels because when the market goes to those levels, there will be certain behaviors that you can tell whether there's a good trading opportunities or not. In general, there are three types of day trading strategies using the previous day high and low. The first one is to use them as the support and resistance. So when the market goes to the levels, it's gonna bounce back. So it's a reversal pattern. The second is the breakout. When it goes there and then it breaks, it doesn't respect it. That means there could be a strong trending market waiting for you. The opportunities in this situation is much better. And then the third is to use it as a profit target and then exit your position. Sometimes in a trade, you don't know when to exit to take the profit because you want to take as much profit as possible, but at the same time, you don't want the market to come back so you lose your potential profit. In this case, previous day high and low can be very reasonable and a good exit profit target. Why we can use the previous day high and low to design some trading strategies? Very important to understand that first, it is mental boundaries and the levels. Both the buyers and the sellers will watch when the market goes to that level, no matter what. Even though they may not be good trading opportunities, but people will watch. Second, there will be a lot of entries and exits when it's approaching the levels. You can see sometimes there will be a trading range and consolidation around that levels. So both the human traders and the high frequency trading will also take advantage of that, especially think about the high frequency tradings. Right, so there are algorithms there. So how do you tell the codes to either buy or sell? It's based on some levels. So previous day high and low will serve as very important levels for the algorithm. First, let's take a look at how previous day high and low can serve as a support and resistance for trading opportunities. When the market goes down to the support, and then if it respects this support line, it's gonna bounce back. So at this moment, here, there's a good trading opportunity for you to enter the market and go long. This is a very simple logic. Sometimes the market goes down to the support to test the levels multiple times. Each time it's testing this level, here and here, there will be good trading opportunities. So in this case, you need to go long. It is the same thing for the resistance. When the market goes to the resistance and then bounce back, there's a good trading opportunity for you to trade short here. And then if it touches multiple times here and here, or even the third time, so you can enter as a short as well. Will the market touch the support each time when it goes there, like this? No, not always. If in the chart, let's say, it goes down, it didn't touch the support level and bounce back, will you be able to trade? Are they good opportunities? Yes. We'll be trading here and here as well and go long, even if it is not reaching the support. This means the market is strong, that the market doesn't even want it to go down to the support and touch it. So this is a strong signal for long, and then you should be prepared to enter it when it bounces back. Then you may have a further question. So what if the market goes down to the support and pierces it a little bit and then goes back? And then this could happen multiple times here. Would there be a good opportunity for you to trade here? Yes, the answer is yes for sure. And then if it pierces a little bit, that's fine because the market always goes by waves, right? It pierces a little bit, that means simply the market is now very strong, it's weak, but it doesn't mean that there's no trading opportunities. So if that's the case, when we see it goes down and goes back up with a very good signal bar, you want to enter long in this situation. Now let's go to the second trading strategy, breakout. So assume that this is the resistance. The market respects it. You can see that. And then somehow the market goes up and then ignore the resistance and break it out strongly. And then when the market goes down, normally it will go to test the resistance again. So right now, the previous resistance will become the support. And then after it tested the support, and then it goes back up. So in this situation, here will be a very good trading opportunities. Whenever you see a green bull bar, you want to go long. It's the same logic for the short. this is the support. It can be either previous day's high or previous day's low, it doesn't matter. But normally this will be a previous day's low. When it goes down to pierce this support greatly, that means it's a breakout, not just push back a little bit and then goes back up. And this breakout will lead to a retest of the support, and then it becomes the resistance here. Then there will be good trading opportunities around this area. So when you see a strong bear bar, you want to enter the market as a short. The breakout trading strategy normally leads to a very strong trend, and there are good opportunities than the support and resistance trading strategy. Why? Think about this. Previously, the market is consolidating, or it is in a pattern already, and somehow it changed the pattern. So to change the pattern, there must be very strong trending or strength or pressure. So that's why when they change the pattern, it will lead to another kind of a pattern or trading strategy. That's why the market will be strong if in this pattern it goes down. So that's why you want to take the breakout opportunities whenever you see. Again, for the breakout strategy to be valid, the breakout must be very strong. Otherwise, if it goes back again, so that means it's still in the previous trading range. And there are also other situations that whether the market should touch the resistance in this situation. It could go down to pierce it and then goes back. There also be good opportunities here. However, this will be a sign of weakness for the market. So you're expecting the market won't go as high as much as possible. And then the second situation is that what if the market didn't go down to even touch the resistance and then goes back? This means the market is very strong. So you want to hold your position and then maybe you do some swing trading as well. Now I have shown you the first two day trading strategies, support and resistance and the breakout. Those two are for the entries, for you to enter the market. And then the third day trading strategy is for you to take the profit. It's very simple. That if you are in a trade and then it's reaching the support or resistance from either way, you want to prepare to exit and then take the profit. That's it. But why you want to exit when it goes to either daily high or daily low? That is because, like this example, you have your own profit target here, and then the market goes up, even it goes above the resistance levels here. However, the market may not reach your target and then goes back because a lot of buyers and sellers will behave around this resistance. So the market could go down here and then maybe go up again and then go down. So it will never reach your profit target. That is why. So realistically, you want to make money by day trading. So a good strategy is that approaching the previous day's high or low, at least you want to take part of your profit to ensure you have something in your pocket. Another thing is that it may not even reach the previous day high and low. It could go up here and then goes down. So you can have your strategy amended like if you take the profit 1 or 2 pips or 1 or 2 ticks before it reaches the previous day high and low to ensure that for the situation that it doesn't reach, then you still have your profit. The same logic when the market goes down to test the support, then you want to exit before or maybe right approaching the support level. Now let me use some examples to show you how to do the trading in the real time. First, let's go to the support and resistance day trading strategies. This is the previous day's low. When the market goes down here, pierce a little bit, but it didn't penetrate that much. It is not a breakout. So when the market goes back up here, you want to enter your market and then trade accordingly. So here will be your entry. You can use this bull bar or even this bull bar when it goes back up. If the market goes down, you're not quite sure whether you want to enter or not. You want to wait a little bit. So here comes the pullback, right? And then after the market goes back up here and then test the previous day's low as a support again here. Here you can enter the market and go long. Then in this situation, it's the multiple testing of the support here. But what is the difference between the entry here or entry here? Let me tell you. The difference is that the market strength are different and also the probability of a long trade is different. That's because when the market goes here, it pulls down a little bit, and then you're not sure whether the market wants to break it or not. That's why when the market goes up to go to a long successful trade, the probability is low. However, when the market goes back up here and then retests the support, you can see that this bull bar with the tail at the bottom, and it just tested the previous day low and then even didn't go down under the day low. So that means the strong market to go up. So that's why the higher probability will be here. Then when you trade here, you see the market has consecutive bull bars. That means it takes off. So the difference again is the probability of long trade. Lower here and higher here. Here's an example of multiple touch, actually 3 touches. So when the market goes down here, basically you can enter if you believe this is a good support. However, you may hesitate because there are consecutive bear bars here. It's a strong downtrend as well. And then the market pulls back and then retests the support level 2 times. For each time, you can enter the market for sure. Here you see that this bull bar tests the previous day low and then it bounced back immediately. So you can enter here. Even though it bounced back again to test again, when you see this big bull bar, that means the support still holds. So you want to go long here. Now let's have a look of another example, which is the short opportunity. So this is the previous day high. You can see the market lingers around this previous day high and then it goes down and then pulls back. So when it pulls back to test and then bounce immediately with this bear bar and also with this bear bar, these two will serve as very good opportunities for you to go short. And then the entry is that when you see the bull bar goes up and then retest failed, and then when you see the first bear bar, you can trade and then go short. One thing to notice is that right now it goes back, touches the previous day high twice. What if it goes back again and touches the 3rd or 4th time? If you're in a position, I suggest you exit the position as soon as possible because this may not be a robust resistance level. The market may not go down. So that's why if you see twice, that's still okay. Then that's another topic that you need to manage your trade if you're in a position. Here's a very unique example of the support. Basically, the market goes down and then penetrate a little bit. If you're not quite sure, you want to wait for the market to go down to test the previous day's low again. However, the second pullback never happens. So then the market goes up. Would there be a good trading opportunities for you to capture this uptrend? It seems that using the support and resistance levels for the previous day high and low doesn't work here. But I can tell you, you can use another day trading strategy to capture it. So basically your entry should be here and the strategy should be V reversal. I have a video for this, you can search in my channel. But here, the logic is like this. Because it bounced back, this previous day's low level still holds. But how do you capture this? How do you know you want to enter here? And the market won't get down here because this is a V reversal. The V reversal pattern is that if the market goes up here and then it's higher, this leg, consecutive bull bars, higher than the previous minor high here, then you want to wait for a pullback and then enter the market. So this is another topic, but still this picture shows you that the previous day's low can serve as a support and then to assist for other trading opportunities. Now let's have a look at some examples for the breakout trading strategy for previous day high and low. You can see the market goes down and then goes up to test the previous day's high. It consolidates a little bit and then somehow there's a big bull bar breaking the previous day's high. This is a breakout pattern. And then take a look at this big bull bar. It is bigger than any of the bull bars or bear bars on the left. So this breakout is very strong. That's why you want to wait for the pullback. Here comes the pullback to test the previous day's high a little bit. And then you also notice that the market didn't even reach the previous day's high and then go back. This means the strong market. And then if that's the case, when the pullback finishes, when you see a good signal bar, you want to enter the market. And then see how later on it goes up very high. If you're in a trade after this consolidation or pullback, you're going to make a huge profit. Now let's have a look at the short opportunities. So when the market approached the previous day's low, you can see that it ignored it. It didn't even hesitate to break it. There's no consolidation, and then it pairs it strongly with the consecutive 2 bear bars here. This means a strong breakout. And then what you want to do is that to wait for the pullback to retest the previous low, and then when you see a signal bar, a bear bar, you want to go short. So here is your entry. The market pattern will not always be ideal or like what's showing on the paper. So you want to know as many possible scenarios you can for your trading. So here's an example. So you can see the market lingers around the previous day's high a little bit, but somehow here there are consecutive bear bars. Then you need to treat this as the breakout from the previous day's high. And then if this is the breakout, and then wait for the pullback. And then there are multiple pullbacks in this situation. And then what do you want to do? Because you see them in order, you're not going to see the second pullback here and the third pullback here. So when you see this bear bar, probably you want to enter the market. And when you see the afterwards the pullbacks here, you want to enter or add up to your position each time as well. So this is the real-time trading, and then to make profit, you have to capture each of the opportunities. There's another very special situation. When the market goes down and then breaks the previous day's low, the things that you want to wait the pullback and then trade here. This is a perfect entry. However, later on, you can see the market goes around the previous day's low for too long. Basically, this is a 10-minute chart. You can see that the market has been around this previous day's low like 2 hours. Will you be confident to hold your position and then trade downward each time? So this is something as a beginner trader you have to learn. And also, to me, this pattern still holds because I don't see the market goes back up above the previous day's low too much. That's why if I'm in a position, I will hold, wait and see. But if the market goes back up, that means this breakout trading strategy is not valid anymore. You want to get out of your position immediately. And at the same time, because of this consolidation is lasting for too long, that means the market strength has been weakened. So you want to know all this information when you're doing the trading. So like I said, because you see the chart in order, it's not going to show you at the same time. So when you first see this bear bar, you already enter the market because later on it appears your level for entry. And then when it pulls back, here's another very good bear bar. If you want to enter, you see the next bar will let you get into the position. And then the next bear bar here, the next bar won't give you a position, but the next, this red bear bar will get into your position for you. So finally, you see this big bear bar here. For sure, you know that, okay, the consolidation is over. So you want to enter the market again if you want to add up the position. So this is how the trading works. You will never know what's going to happen for the next few bars, but you need to be ready for trading and enter the position very firmly. In this chart, you can see the market breaks the previous day's high with consecutive bull bars, but the bull bars didn't break too much. Normally, if you think this is a breakout strategy, you can enter, and then when you see the pullback here and then retest the previous day's high, and especially when you see this big bull bar here serve as a signal bar, you can for sure enter the market. And then after you enter the market here, you can see it takes off. So that means this break is valid. However, if you hesitate when you see this breakout and then goes down, you're not quite sure whether it's going to go back down to the downside. What you want to do is that you just wait a little bit. And then later on, when you see these consecutive bull bars here and combining with the previous a little bit breakout, you can treat this whole area as one breakout, right? So this is a 10-minute chart, but think about this. If you use a 30-minute chart, this will be just a big bull breakout leg there, right? So, and then what you want to do is that the same thing, wait for the pullback, and then find a good signal bar, and then enter the market. So when you do the trading, you need to be flexible a little bit. In this chart, you can see the market goes up to test the previous day high. However, for so many bars, it's not going anywhere. It's testing the previous day high. So in this situation, what do you want to do? So whenever it breaks out this trading range, the small trading range, the first bar, either it is a bull bar or it is a bear bar, you want to trade because that big bar will show you the direction. That's why when you see this big bull bar, you want to enter after it finishes. To look at the same chart from another angle, here we can treat this up as the first leg. And then horizontally, this is consolidation or pullback. And then another leg up. So in this, we want to treat this market as a wave. The first wave and the second wave. So if that's the case, this market normally will follow measured move. You can see that the distance for the first leg going up should be similar to the second leg up. Now I have shown you the first day trading strategies for the support and resistance and also the breakout. Those are for the entries. Now let's have a look at the third day trading strategy to use the previous day high and the low as the profit target. In this chart, you can see that if you're in a short trade and then you capture this big downward breakout, then you want to set your profit target as the previous day's low. If that's the case, you can see that you exit the market here. But at the same time, you also notice there are two big bull bars here, consecutive two bull bars, and pulls back. You may wonder why there's two bull bars here. Because some other traders may take the profit before it reaches the previous day's low. They want to lock in their profit. That's why when you see this, you may need to think whether you want to set your profit target exactly as the previous day's low here, or you want to use the same strategy to exit the market a little bit earlier. Because if you don't, then the market could go back more. And also the thing is that when you are in a position, when you see the pullback, are you able to sit tight? Right? So that's the questions you want to think about. Here's another example for the previous day's high. So when you are in a trade, for sure, this is your profit target. But similar situation, you can see that the market goes here and then consolidate a little bit. That's why when it's consolidating, you may doubt whether the market will reverse or not. So it's not saying that you have to take the profit before it reaches the previous day's high and the low. It really depends on your study of the previous day's chart. If you find out that the market most of the time will reach the previous day high and low, just be firm with your profit target. Otherwise, you will want to exit the market before it reaches the previous day's high and the low. This chart shows a very good example to take the profit exactly at the previous day's high. You can see that this bull bar with a very big tail at the top, and then it just penetrates the previous day's high a little bit and then comes back down. That means other traders are using the previous day's high to exit the market as well. So that's why there's a big tail at the top. But at the same time, you also see the market goes up even further later on. And then you notice that there's a R1 here. This is the pivot level. So some of the other traders may use R1 as the profit target or exit the market. So this is another topic. I will have another video. But you need to understand the market goes by levels. So if you're using previous day's high, but some other traders may use the R1. Here's a little bit more complicated situation. So in this chart, when it goes down, if you use this previous day's low as the profit target, for sure you can exit. But at the same time, it goes down here, you can also enter the market because it is a penetrate. And then it's a breakdown. This big bear bar is huge. That's why the downtrend pressure is huge. That's why you can enter the market as well. And then at the same time, you can see there is a S2 and S3 at the same time on the chart. Then when the market goes down here, you can also use S2 or S3 as the profit target, exit the market. But at the same time, think from another angle that when it breaks this previous S2, goes back, pull back, and then it's also a good opportunity for you to enter the market. And then take a look at here. When it breaks the previous S2 here with strong consecutive bear bars, consolidate a little bit or pull back. And then you can also enter the market, go short, and target the S3 as your profit, right? So in this situation, you can see the market even didn't touch the S3 because the probability to reach S3 is very low. So on this chart with multiple levels, you can see that the levels, you can use it as both entry and exit based on your trading strategy. Now let me show you the last, more complicated situations. In this chart, you can see that clearly that here, the market respects the S1. And then S1 at the same time is very close to day low. They are almost at the same level. And then when you see this huge bull bar, you want to enter the market to go long. And then set a target as the previous day's high. There's no issue, no doubt with it. You can see the market respect it because there's a tail, big tail at the top. That means some traders will exit the position here. However, later on, the market goes up. You can also set your target as S2. If that's the case, you're gonna exit around this area. Or you can set your target as S3 and then you will exit around this area. These three levels, previous day's high, which is the same as the R1, R2 and R3 are all good profit targets. So whether you want to exit here as the previous day's high or you want to exit in other levels, then you need to do more studies to see historically which makes more sense. And then each of the levels, the difference I can tell you is the probability of reaching it. Hopefully after you watch this video, you will have a better understanding than before on how to use the previous day's high and the low for your day trading strategies.